The new Financial Conduct Authority (FCA) price walking ban promised to stop insurers overcharging loyal customers. But did your car insurance actually get cheaper? We analyzed the data, dissect the market response, and explain precisely what the ban means for your next renewal quote, revealing the complex financial shift in the UK motor insurance landscape. For decades, the UK general insurance sector operated under a deeply entrenched, structurally flawed, and financially exploitative principle known as price walking. This insidious strategy involved insurers using sophisticated, data-driven algorithms to offer unsustainably low introductory premiums to attract new customers, while simultaneously and systematically engineering massive year-on-year price hikes for their existing, loyal customers who passively renewed. The financial damage was coined the loyalty penalty, an unearned tax that saw trusting customers subsidize the aggressive discounts given to the savvy market switchers. The practice was not merely sharp business. It represented a fundamental ethical failure and compelled the Financial Conduct Authority (FCA) to enact sweeping, market-altering reform. Section 1. The Anatomy of Exploitation and the FCA's intervention. The psychology and mechanics of the loyalty penalty. Prior to the regulatory changes implemented in January 2022, the UK car insurance market was a two-speed economy. The price-walking mechanism relied heavily on actuarial and behavioral psychology, segmenting customers into two profit pools: hunters, active switchers, who demanded the best price, and sleepers, passive customers, who accepted their renewal quote. The algorithms became highly accurate at identifying the sleepers, allowing insurers to gradually, but drastically, increase their renewal prices, often by significant double-digit percentages, safe in the knowledge that inertia would prevent the customer from leaving. Industry studies repeatedly confirmed that loyal customers were routinely paying anywhere from 35% to 50% more than an equivalent new customer for the identical level of cover. This systematic overcharging directly contravened the principle of fair value. The regulatory hammer. Enforcing price fairness. The FCA formally introduced the General Insurance Pricing Practices Rules, which became effective on January 1, 2022. The core mandate was simple, but revolutionary: to dismantle the loyalty penalty entirely by establishing the rule that insurers must not charge an existing renewing customer more than they would charge an equivalent new customer for the exact same policy sold through the same sales channel, for example, website, app, or telephone. This mandate achieved two critical objectives. First, it forced the convergence of new business pricing (NBP) and renewal pricing (RP). Second, it destroyed the insurer's economic model of cross-subsidy, where the massive profits generated by the loyal sleepers were used to fund the loss-making introductory prices offered to the hunters. The rule's objective was explicitly to achieve fairness in pricing, not necessarily to reduce the overall market price. It was widely anticipated that introductory deals would rise to meet the renewal prices, creating a new, higher, and more stable floor price for the entire market. Section 2. Market shockwaves, inflation versus regulation. The convergence effect and the initial shock. The immediate, tangible impact of the ban was a rapid convergence of prices. The most heavily penalized loyal customers experienced significant, even dramatic, reductions in their renewal quotes. However, the anticipated corresponding surge in new business prices also occurred, eliminating the era of unsustainably cheap entry-level policies. The market was expected to stabilize around this new, fairer equilibrium. Crucially, this stability was shattered by overwhelming macroeconomic pressures that began to peak in 2023 and accelerated into 2024. The average cost of car insurance for all UK drivers began an unprecedented steep climb, reaching consecutive record high averages that far outpaced general inflation. This spike was a confusing phenomenon for consumers, who questioned whether the ban had actually failed. The data shows, however, that the massive price increase was a convergence of two distinct pressures: regulatory convergence and claims inflation. The true drivers of post-ban price inflation, the primary forces relentlessly pushing premiums upward, were external to the FCA's regulatory mandate. These drivers account for the bulk of the record-high premium increases experienced by consumers today: claims inflation and supply chain crisis. Global and domestic inflation dramatically increased the cost of claims for insurers. The cost of replacement parts, particularly those required for highly technical modern vehicles, ADAS sensors, complex lighting units, surged. Furthermore, the rising wages for specialist mechanics, extended repair times due to supply chain backlogs, and the higher cost of providing courtesy cars all contributed to a massive increase in the insurer's cost of underwriting. This unavoidable operational increase was immediately factored into all new and renewal quotes. Increased frequency and severity of risk. Following the end of COVID-19 lockdowns, the volume of road traffic accidents returned to pre-pandemic levels. Simultaneously, there was an alarming rise in vehicle theft, particularly using sophisticated keyless relay attacks. Insurers' actuarial models registered a significant, undeniable increase in the frequency and severity of expected claims, directly necessitating higher premium quotations across all segments to maintain solvency. The loss of arbitrage profit. The ban utterly dismantled the financial arbitrage opportunity that once existed. Since insurers could no longer rely on using the enormous margins from passive customers to subsidize promotional deals, the entire cost of risk had to be borne by the individual policy from year one. This immediately raised the price floor for every new market entrant, making the cheapest available quotes substantially more expensive than they were before 2022. Section 3. The new equilibrium and financial consequences. The new pricing model. Profit from day one in the pre-ban environment. Insurers often deliberately incurred a small financial loss on a new customer in year one, confident they would recoup that loss and secure substantial profit during years 2 through 5 via price walking. That model is now illegal. The new financial imperative is to secure a narrow, sustainable, and transparent profit margin on every customer from day one. This means prices have converged, reflecting the true cost of underwriting plus a small, consistent profit buffer, eliminating the extreme highs and lows that defined the previous market. Defining the financial casualties and the major winners. The FCA's intervention created a clear redistribution of financial burden across the UK driving population. The major winner: loyal, passive customers. This group, who previously faced the most punitive annual increases, often seeing their premiums jump by £150 to £300 at renewal, saw their renewal quotes become significantly fairer. The elimination of the loyalty penalty meant their renewal prices were far closer to the current market rate, resulting in the greatest immediate financial relief. The financial casualty: savvy switchers, the arbitrageurs. This group, who defined the pre-ban market by continually jumping ship to exploit 30% introductory offers, found their savings evaporate. Introductory discounts became marginal 5% to 10% maximum, and their starting premiums were raised to cover the true cost of their risk. Their ability to game the system for massive year one savings has been largely eliminated. The second casualty: new drivers and market entrants. Young drivers, or those new to the UK market, often relied on the aggressive loss leader pricing to secure affordable initial policies. With the disappearance of cross-subsidy, the entry-level price for these high-risk groups has been raised substantially, creating a higher, more prohibitive cost barrier just to obtain their first policy. The core result of the ban is a market that is undeniably fairer on a customer-to-customer basis, but also undeniably more expensive due to the convergence of prices with soaring claims inflation. Section 4. Tactical mastery for your next renewal. The FCA ban has not eliminated the need to shop around. It has simply changed the reason for it. Never auto-renew remains the golden rule, but the strategy is now focused on finding the insurer whose risk algorithm likes you the most, rather than the one offering the biggest introductory bribe. Master the 21-day window. Optimal pricing frequently occurs between 21 and 28 days before your renewal date. Insurers use dynamic pricing models that often penalize last-minute shoppers, perceiving them as higher risk or apathetic. Secure your quotes early to capture the best rates. Focus on value-added services, since the price gap between the best and worst quotes is now much narrower. Often £50 to £100 savings instead of £300, the emphasis must shift to policy quality. Evaluate the cost and inclusion of critical add-ons, guaranteed courtesy car provision especially for total loss, motor legal expenses, and lifetime repair guarantees. A slightly higher premium may be justified if it guarantees superior service during a claim. Strategic voluntary excess. While increasing your voluntary excess will lower your premium, do so strategically. A jump from £100 to £250 may yield significant savings, but increasing it beyond £500 often results in diminishing returns while substantially increasing your financial exposure in the event of a claim. Find your optimal balance. The power of policy detailing. Minor adjustments can significantly impact your risk profile in the new pricing environment. Always ensure you accurately detail your annual mileage. If you drive less, the price should reflect it. Your job title using the most precise, lower risk variant, and carefully consider whether to add a named driver with a clean record, which can often signal reduced risk to the insurer. In conclusion, the FCA's price walking ban was a landmark regulatory success that achieved its primary mission, ending the exploitative loyalty penalty and delivering price fairness to the market as passive majority. It broke the structural manipulation that enriched insurers at the expense of their most loyal customers. However, the subsequent collision with unprecedented global inflation and soaring claims costs meant that, despite the new fairness, the overall cost of car insurance for virtually every UK driver remains at a record high. The key to financial prudence is now about finding the insurer that values your risk profile the most, rather than simply hunting for the biggest, unsustainable introductory discount.